Time to check out the latest stock market action. We have Yang Jun-sok, professor of economics from the Catholic University of Korea, with us on the line. Professor Yang, thank you so much for making time for us today.
Happy to be here.
Well, first of all, let's begin with over on the Wall Street, where U.S. stocks didn't notch impressive numbers. There are still fears of a recession looming, and some major players are pulling out. How long will this trend continue?
Well, it seems like it'll continue until at least the first half of 2023, so I should explain why. Last week, the stock markets actually did fairly well, but perhaps it was a bit of an undeserved euphoria. The rise last week was triggered by the Fed Chairman Powell saying that it's likely that the increase in interest rates will be slowing down from now on. So we had optimistic interpretations about that, but there was also sort of the second part of that speech, or the signals that the Fed has been giving out, which is that the interest rates, the peak interest rate, how high it'll go up until it starts falling, will now be higher. Previously, around September or October, the peak interest rate was thought to be going to be around 4.75%, but now it seems like it'll be somewhere between 5 to 5.5%, and some of the hawks in the Fed are saying that it should actually go higher than 5.5%. And the period of increase, it was thought to end around the early part of 2023, but now it seems like the interest rates will keep on rising, though at a slower pace, for most of the first half of 2023. And again, hawks are saying that it may go on for longer. So we may be just catching up to the stock market, finally realizing the other part of the speech that the Chairman Powell has given last week. And further problem is that despite the 400 basis point rate increase that the U.S. had so far this year, the labor market is still unbelievably strong. The November unemployment rate was only about 3.7%. That is way below what the U.S. had considered to be their full employment rate, which was around 4.5 to 5%. The wage hikes are still at a 5% range, which is behind inflation, but still very high if you consider the Fed's target inflation rate of 2%. And while these are October numbers, these are the latest numbers we have, but job opening and labor turnover JOLT report says that there are still about 10.3 million job vacancies in the U.S. That's more job vacancies than the country saw before the pandemic at 2019. So even though there are some signs that the U.S. economy is slowing down, and we have some very widely publicized layoffs in big tech and financial sectors, such as Facebook, Twitter, and Morgan Stanley, the U.S. labor market seems to be still incredibly high, and then the spending also seems to be incredibly high. We don't have the final numbers in yet, but Thanksgiving sales seem to have been very, very good. So year to date, though, the Dow is down 8.1%, S&P is down 17.9%, NASDAQ is down 30.8%, and Asian markets, the Nikkei is down, Shanghai and Hang Seng is up. Hang Seng is up by more than 2%, and that seems to be because China seems to be getting away from its zero COVID policy, as you mentioned in the last story. That means that we can hope for Chinese economy to pick itself up again. That'll be good news for Korean exports because, well, part of the decline in Korea's exports in recent months has been because of the shutdowns in China, because in the factories because of the zero COVID policy. But there might also be some bad news because China is the biggest consumer of oil. So if Chinese economy starts picking up again, oil prices may start to go back up, and that means higher inflation. So we'll have to see whether the good outweighs the bad.
And shifting our focus back to South Korea here, Professor, the local bourse, among others, had some promising starts and little sparks here and there, but did wrap up the day down again. If we were to single out some standout performers, there was SK hynix, LG Chem, Naver and Celltrion. Help us break down the figures.
Okay, well, the KOSPI is down by 0.5%, and it ended today at 2,371.08. Kosdaq is down 0.8%. and it ended today at 712.52. Korean won, though, bit of a good news, appreciated by 0.08%, but it is still above 1,300 at $1,319, 19 won per U.S. dollar. The downfall in the market today seems to be because of the worries about global recession that's coming from the United States, as well as the drop in the U.S. markets themselves. It may also have to do with concerns about the availability of funding for Korean companies. We had some problems in the bond markets, and Bank of Korea has announced that they will provide more liquidity through repo purchases because they expect some shortage of liquidity toward the end of the year. So that might be worrying the market as well. Year-to-date, KOSPI is down 20.7%. KOSDAQ is down for the year by 31.4%. And Korean won, for the year-to-date, the won has depreciated 11% against the dollar.
The FOMC, next week, its final policy meeting of the year. Analysts expect a smaller rate increase. Meanwhile, silver and copper prices are on the rise.
Yeah, gold is usually considered either an inflation hedge or a risk hedge. So because of rising inflation and because of the more risky global economy, we really should expect gold prices and silver prices to go up. But if you look at it sort of more in the long term, that's not really been the case in the recent months. Gold started from a low of $1,100 per ounce in July of 2019, hit a high of $2,034 per ounce in August 2020. That's the height of lockdowns and shutdowns during the pandemic. Then it stabilized around $1,775 until March, when it rose to about $1,985, and then it fell to $1,643 before stabilizing again on $1,775. And right now, that it has risen slightly above that $1,775. It was $1,783 per ounce when I checked during lunchtime. And again, the big question may be not that it rose yesterday, but why isn't it doing so well in the last few weeks? And it may be that people feel that gold is not as good an inflation hedge or a risk hedge as it had been in the past. During the pandemic, the other securities, stocks, bitcoins, cryptocurrencies, even housing, they seem to have made much more splash than gold as both risk hedge for risk and inflation hedge. Similar with silver. Silver is roughly following the path of gold. And so, again, we may see that the precious metals have lost perhaps some of their meaning as a risk hedge and an inflation hedge.
Right. Professor Yang, thank you so much for sharing your insights with us today. We appreciate it.
Thank you.